Hi, I'm Ardi from Billionaire Wannabe's group. Would like to share our insights from a renowned book, The 5 Rules for Successful Stock Investing by Pat Dorsey. This video is a part of our group assignment for corporate finance class in the IPMI's Executive MBA program by Prof. Roy Sample. Let's get it on then. So, what are those rules mentioned in the book? Rule number 1 would be do your homework. The most common mistake from investors is they don't study enough of the company they would like to invest. You need to develop a certain understanding of accounting to know the condition of the company, spend time to research about the company from its annual reports, and basically understand their competitive environment. So unless you really know the business inside out, you should not invest the stock. The second rule is knowing the economic modes. This rule will be further explained by my friend Pak Ruslan. So we go to the next rule, rule number 3, which is have a margins of safety. Since there's no certainty in the future, you will need an extra cushion in case things turn out worse than expected. So margin of safety is basically when you buy a stock at less than its intrinsic value, because after all, not making any income is better than losing money. Rule number 4 is long-term holding, because you need to always keep this in mind whenever you buy stock. You need to have a long-term holding in mind, because frequent trading leads to paying higher transaction costs and taxes, and this money cannot be compounded to the next year. Rule number 5 for the last rule is know when to sell. You should never sell just because the stock dropped or skyrocketed. In short term, this movement gives you no information, and basically this movement can be very unreasonable. So you should sell only if you've done some mistake in your initial analysis, or you missed something, or you find deterioration in the company's fundamentals. You should sell your stock if the stock price have risen way too much above its intrinsic value, or if there's something better to do with your money. So you might as well just use the money for something much more purposeful. And you should sell only if the stock has too high portion in your portfolio, or saying that it carries much bigger weight in your portfolio. Thank you.
Hello, I want to introduce you to 7 easily avoidable mistakes that many investors frequently make in chapter 2 of the book. First, swinging for the fences. Always focus on buying a great company with a strong economic fundamentals. Second, believing that it's different this time. History does repeat itself. Bubbles do burst, and not knowing market history is a major handicap. Third, falling in love with products. Although great products and innovative technologies do matter when you are assessing companies, neither matters nearly as economics. Fourth, panicking when the market is down. It's very tempting to look for validation or other people doing the same thing when you are investing. But history has shown repeatedly that assets are cheap when everyone else is avoiding them. Fifth, trying to time the market. There's no strategy that consistently tells you when to be in the market and when to be out of it. 6. Ignoring valuation. The only reason you should ever buy a stock is that you think the business is worth more than it's selling for, not because you think a greater fool will pay more for the shares a few months down the road. 7. Relying on earnings for the whole story. The most important thing that matters in the business is free cash flow and not the earnings. Thank you.
Hey everyone, this is Ricky. In my part, I will tell you the 2 most important things within the book, which are company's financial statement and analyzing the management. What are the things that we need to know about financial statement? The first one is growth, second one profitability, the third one is bear case. Growth, such as historical growth. Is it consistent? What are the growth factors? What are the sources of the sales growth? Which division or what product? The quality of sales growth is important in this book. Tells you if earnings growth is more than sales growth, check the number of how the company get more profit from stagnant sales. The second one is profitability. Of course, within the FRA, check the return on asset and return on equity. And sometimes you need to check the return on invested capital. Then maybe can compare to the industry and see whether the company doing well or not. The third one is bear case. By bear case means that what could go wrong with investment thesis, your investment thesis in this case. This is need to check after we find out about company's growth and profitability. Check why someone prefer to be buyer or seller of the stock. Building a convincing bear case is important, so you know when the timing is to buy or timing to sell. The next one is what are the things we need to know about company's management? First one is compensation. Second one is character of the company. And the third one is operations. Compensation. When we talk about compensation, we need to check around if the company gives the compensation to stakeholders with the firm size and its financial performance versus the company within the same industry. Second one, character of the company. You need to check the employee turnover rate. Is it high or is it low? What do you think? Does the board consist of family or friends related? What are the management style about business analysis and business decisions? Are they transparent? Number 3, operations. Check the increasing return on assets and return on investment. Are return on investment increasing because too many leverage? How the management allocate its capital efficiently? You can check with its non-current liabilities. That's all from my part. The next one will be explained by Pak Tommy regarding valuation methods. Thank you.
Hello everyone, so we're going to continue. The next part is valuation. So like Dorsey wrote in his book, even the most wonderful business is a bad investment if the purchase price is too high. And he also wrote that in order to become a successful investor, you need to buy a great company at an attractive prices. So he talked about valuation of the company, and one of the methods that he used is price multiple. The first ratio that he wrote in his book is price to sales, where he compared the price against the sales per share of the company. And but you need to be careful when you're using this ratio, because as you might know, some industry or companies might have really high sales but with low margin, and there's also a company or industry that have a really low sales but with really high margins. The second one is price to book ratio, where I compare the price to the book ratio of the company. But he also warned that nowadays a lot of companies are using intangible assets to create wealth, and that doesn't really reflect on the book. So you need to be careful also when using this. But it's better if you use other ratio, like compared to the return on equity or return on asset when you use this ratio. The third one is one of the most widely known and used worldwide. It's basically the price to earnings. When you compare the price to the earning of the company to predict what's the value of the company based on the earnings. And the fourth one is price to earning growth, where you put the growth as a factor. And Dorsey also talk about yield. Yield is basically the net investment you can receive in percentage. So one of the use of this yield is to compare your investment to other opportunities, such as, let's say you have a chance to put your money or your saving to a stock market with a yield of 3%, or put it at other asset with better or smaller returns. And then Dorsey talk about cash flow. One of the method that he used was the discounted cash flow method. And basically after that he explained when to buy it, what you need to do, to filter the stocks before you buy it. And overall, it's a really good book. We really recommend this book for everyone, no matter if you're a beginner in the stock market or a seasonal investor. It's a good book for freshmen also. So we really enjoy this book. We would like to thank IPMI and also Prof. Roy Samble for his corporate finance class, that we have the chance to actually learn about this stuff and try to improve our knowledge within the stock market. And on behalf of my team, Pak Ardi, Pak Ruslan, Pak Riki, and me, Tommy, I would like to say thank you for everyone for watching in, and stay safe and stay healthy. Bye bye.